Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to discuss what do you do if you have $1 million in equity or in deposit. So it could be a combination of cash and equity. Now, one of the things that stopped a lot of people buying any kind of investment, whether it's residential or commercial, has been servicing. Now, with the interest rate going up, servicing has become a huge issue, and that's why people have actually pivoted to commercial, because if you buy in metro areas like Sydney, Melbourne and Brisbane, it is at least a neutral hold rather than taking money out of your own pocket and actually footing the bill. Now, back in the day, it used to be if you had a clear title where you basically had paid off your mortgage. Now you can refinance against it and put the commercial against it, and voila, off you go, right? Especially with the value going up on the residential. But that's not how it happened, right? Now the banks want 3 times servicing for the residential property to pull out that equity to do any kind of deal, right? But to do also then the deposit for a commercial deal. So that has stopped a lot of people drawing down equity. So if you have a combination of cash and equity and you want to buy a commercial property, there's a way to do it. You've got to hit a minimum return, and that return has got to be somewhere around 8% or above, right? And that may seem really hard, right? So that's got to be looking at particular areas where you're trying to balance the risk but not going to mining. And that's where, Unicorn really specializes in portfolio design and getting you out there, right? So let's say that $1 million that you have, what should you do with it? Well, number one thing is to be really clear that you are now not buying one property, you are building a portfolio. Now, a lot of people think, I'll just take $1 million, I go to a buyer's agent, and voila, they magically bring me a $2.5 million property. Well, that's not how it works. You really need to think about the strategy behind it, because remember that $1 million need to grow, right? And you want it in the next 3 years from that $1 million to preferably make it $1.5 to $2 million coming back to you, right? And that is the key to it. So, well, how does that work? Well, number one, when you have $1 million on a lease stock loan, that's $2.5 million in a portfolio. And if you have $1 million and you can leverage higher, let's say that you don't have any other outstanding debts and you're not highly leveraged, you can go up to $3 million. So $2.5 to $3 million is your portfolio. And you got to think of it, you're building a portfolio rather than buying one property. Now, doesn't mean that you go and buy 500,000 and buy 5 of those, right? That's a disaster. But you got to build in some diversification. So number one, the first other thing you need to think about is, where is my next deposit after my $1 million? Is there a chance of my getting another 200,000, 300,000? Now, if it is, then the equation changes how you build that portfolio, because you've got a lot more money coming in, and that money might go towards an uplift. So you might find something with a partial vacancy that you can, spend some money on it. If there's none and there's $1 million and that's it, then you got to go, well, how do I build that portfolio? So the idea is 2 to 3 properties during that time. Now, the number one property you should do is definitely the first property you do is cash flow, right? Cash flow, because it balances out the rest of everything you hold, right? So that means that if you take $1 million, and the biggest bang for your buck right now is probably between 1 to 1.5 million in a regional area, right? A regional area, 1.1 to 1.5 million at 7% yield is what you are looking for in terms of a property that is going to deliver you the 7% return, which means it allows you to pay fully for all the outgoings are taken out, right? It's $70,000 net, right? And this is because, commercial property, the tenant pays the outgoings. $70,000 is going to cover your mortgage, some mortgage fluctuations, plus give you positive cash flow. So nothing out of your own pocket, which is really important. It allows you to put some money away as well for a rainy day. So that is important, and that's going to neutralize everything else. So if you've got a residential property that is going to be a bit negative, that's going to help you support it. You're doing some business stuff that's going to be negative, that's going to support it, right? So that's your baseline, right? You got to build your baseline. So foundation, biggest bang for your buck, 1 to 1.5 million for a property in regional. And what you're going to do is try to leverage as much as you can against that, because there's cash flow, right? So you want to get the highest LVR you possibly can. So if you can access like a loan that can give you 70-75% LVR, then that's what you want to do. If you can't and you can get 65%, that's what you go for, right? That's where you want to be, right? You want to get a good 7% yielding property then. After that, you then take that property and go, okay, well, I now need to consider 2 things. Now you have a choice, right? I would go regional or metro. Now that really depends the rest of your portfolio. If you have a lot of residential and you want to start changing your portfolio to a commercial base, that extra other property got to go in regional. If you have residential and it's neutral or paid down or paid off, and the cash flow isn't so important, you just don't want to have the burden of holding, but you want to switch and diversify, then you need to take that money and go to a metro area. So you're looking for a Brisbane, you're looking for a Gold Coast, you're looking for Melbourne, you're looking for Sydney, and Secondarily, I would look at South Australia, and the reason I would do it secondarily is because you're chasing growth on a neutral hold, right? Ultimately, you want to tip the balance of your portfolio so that you have more cash flow as you go to the trajectory of retirement. However, you have to have some growth, right? Because this is the idea, right? If you're building a $2.5 million to $3 million portfolio, you have one stable income that's always there. That's the constant income. You build one or two other properties there that is going to be a growth property. And that growth property over time will grow higher than the property that's going to give you the foundation cash flow. These properties won't grow as high in terms of its cash flow, but it will grow exponentially in its growth, capital appreciation. Now, once it gets to a point, and this may be 5 years from now, it may be 3 years from now, the property has reached its peak or that area has changed and you think, look, I've got the best out of it now. What do? Is you sell one out of the two growth properties that you have, and you take that one and you pay down the debt on your cash flow property. You always keep your growth property leveraged, but you pay down your cash flow property because that gives you more cash flow, allows yourself to have a better lifestyle, but also allows the cycle of it in your portfolio to be able to support other things you do, right? So you've got to maintain your cash flow property always constantly in the background. Now, the most important thing that people forget as they build is that they're so focused on cash flow as a secondary thing. They're so focused on the growth, and they forget that at some point that's going to come crashing down if they don't have cash flow. Always think cash flow foundation. As long as you have a stable cash flow foundation, you can keep going, right? And that's the fundamental thing to take for it. When you have $1 million, now you're building a $2.5 to $3 million portfolio. You are no longer buying one property. Now, if you've got $1 million and you've got $500,000 coming in 2 years' time, you've got money out of your super, you've got some resi you're going to sell, that's a different design. That is totally different. That is something you've got to consider now looking forward 5-7 years to see how you can put that mix together for a better retirement at, say, maybe $300,000 passive income, $500,000 passive income, rather than just taking the $1 million in isolation. Now, you should never, when you build a portfolio, take a deposit and buy a property in isolation to everything else you have. If you do that, you're actually doing a disservice to your portfolio. You got to think more holistically of the big picture you want to be, and you got to look at which pieces strategically get you there. It's like playing chess, right? So your $1 million now is a portfolio build. And when you do a portfolio build, you need professional advice, someone who can help you structure it, someone who can help you do asset protection and basically tax minimization. You'll consider factors like depreciation, and you've got to consider location, growth, cash flow, diversification, different types of property, how long should you hold your residential before you sell it, what money you're getting into, what's coming out. So all of those factors are overlaid on top of each other, plus the finance calculations as well. So not anyone can do that out there, right? There's only specified professionals that do that, and this is what we do here at Unicorn Commercial Property, is that we really specialize in helping people build that portfolio, but doing that design and the strategy and helping you to implement. So connect with us, helen@unicorn.com.au, find out more and join us for one of our challenges and order the book, and really let us help you build a cash flow rich but sustainable portfolio through commercial property. In the meantime, hit the bell, subscribe, see you in the next video. Bye for now.